Is the AI bubble about to pop? Today, we're going to look at the warning signs coming from Oracle, what they really mean for the AI sector, and I'll show you a company that's completely unrelated but has tech-level profits and is on sale right now. Oracle's credit was just downgraded because of its massive AI spending. But while everyone is looking at tech, this other company is quietly growing, treating its shareholders incredibly well, and its stock could have a huge upside from here. Let's start with Oracle. The news hit that their credit rating was lowered, and the reason is the enormous amount of money they are spending to build out their AI infrastructure. Many people see this and immediately think, this is it, the bubble is bursting. But that's not the real story. This is an Oracle-specific problem, not a sign of a sector-wide collapse. The AI cycle is in a healthy growth phase, not a bubble. The reality is that building the future of artificial intelligence requires an insane amount of capital. We're talking about billions upon billions for servers, chips, and energy. This increases the risk premium for companies trying to compete. A risk premium is simply the extra return investors demand for taking on more risk. So what we're seeing is not a bubble popping, but the cost of entry going up. In fact, the investment needed is so massive that the U.S. government will likely have to step in and support this infrastructure build-out to maintain its technological edge against other countries. The AI revolution is real, but it has a dark side that isn't being discussed enough, especially in places like Spain, a potential labor apocalypse. AI could wipe out entire categories of jobs, particularly affecting younger generations like Gen Z and millennials who are just starting their careers. This is a long-term risk we need to watch closely. While this threat develops, the market seems distracted. The S&P 500 is rising and gold is hitting new highs, but Bitcoin seems stuck. Later, I'll tell you exactly why Bitcoin's price isn't moving despite all the ETF inflows. This is the kind of analysis you won't find on the mainstream news. If you want to stay ahead of the curve, make sure you subscribe to the channel so you don't miss these insights. Now, let's leave the macro noise behind and talk about that company I mentioned, a business so good it's a must-hold for the long term. Let's talk about Zoetis, ticker ZTS. Zoetis is the global leader in animal health. They create and sell medicines, vaccines, and diagnostic tools for both pets and livestock. They are, quite simply, the best at what they do. Their market position is dominant, but what's truly impressive is their profitability. Zoetis has gross and net margins that are comparable to a big tech company. We're talking about gross margins around 70%. That means for every dollar of product they sell, 70 cents is gross profit before other expenses. That is incredible. This growth is fueled by a powerful, long-term trend, the increasing bond between humans and their pets. People are treating their pets like family and are willing to spend more than ever on their health and well-being. This is a trend that isn't going away. Now, you might have heard about some recent issues with their popular arthritis drug, Librela, and yes, that is a challenge for them. But Zoetis is not a one-trick pony. The company has a highly diversified portfolio of products, which protects them from a single point of failure. Furthermore, they are investing heavily in research and development to address these issues and to continue innovating with new products. This is what great companies do. And here's the best part for us as investors. Because of these concerns, the stock has been unfairly punished. Zoetis is now trading at a historically low PE ratio. The PE ratio, or price-to-earnings ratio, is a simple way to see if a stock is cheap or expensive compared to its profits. Right now, Zoetis is cheap relative to its own history and its future potential. My analysis points to a price target that suggests a significant upside from current levels. On top of that, management is shareholder-friendly. They consistently increase the dividend and strategically buy back their own stock, which increases the value of every share you own. Okay, let's quickly go back to Bitcoin, as promised. Why isn't it taking off with all the new ETF money pouring in? The answer is simple. Early adopters are selling. People who bought Bitcoin for pennies years ago are now taking profits. This massive wave of selling is absorbing all the new institutional demand from the ETFs. But while the early holders sell, big institutions are buying. The dynamic is clear. Look at gold. Its bullish upward trend is strong and intact. Once the selling pressure from the early Bitcoin investors subsides, I expect Bitcoin to follow a similar bullish path. So, to recap, don't panic about an AI bubble because of Oracle. The AI revolution is real, but be aware of the long-term labor risks. And more importantly, in a market full of noise, quality companies like Zoetis offer a clear path to long-term growth at what I believe is a very fair price today. It's a fantastic company to hold in a portfolio long-term with periodic monitoring. If you got value from this breakdown, do me a favor and subscribe to the channel. It's the single best way to support this work. What do you think? Is Zoetis on your radar? And are you worried about the impact of AI on your job? Let me know in the comments below.